This is how financial crisis really began.
Dubai was finished. There was an economic crisis.
Yes, I mean, some papers say that, but
Not with breaking news.
More than 268 ballistic missiles, around 15 cruise missiles.
Not with panic on your screen, but silently, underneath everything right now. While most of the people are watching stock market, crypto, and headlines, a massive shift is happening in the global economy. And almost nobody's talking about it. There are trillions of dollars tied up in the real estate market around the world. Office buildings, commercial tower, entire city centers built on one assumption, that demand would always be there. But what if that assumption is breaking? What if the real risk isn't what everyone is watching, but what they're ignoring? According to reports from Bloomberg and warnings from major institutions like Morgan Stanley, there are early signs of stress building in part of the real estate market that most people never even think about. And here's the most important part. When something this big starts to shift, money doesn't just disappear. It moves, and it moves really fast. The question is where it's going and who is paying attention early enough to benefit. Because in every major financial shift, there are two types of people: those who react late and those who position early, before everyone else truly sees it coming next, now fast ahead. Now let's break down what's actually happening behind the scenes. This is not about houses or apartments. This is about commercial real estate. Office buildings, business towers, corporate spaces that power entire economies. And right now the system is under pressure. According to Bloomberg, more than $1 trillion worth of commercial real estate debt in the United States alone is facing serious stress over the next few years. That means loans are coming due and the owners need to refinance. But here's the problem. Interest rates today are the highest they've been in years. So instead of cheap debt, property owners are now forced to refinance at a much higher cost. And many simply cannot afford it. At the same time, demand has changed. After 2020, millions of people stopped going to office. Remote work has become normal. Hybrid work reduced space needs. So now you have a dangerous combination: falling demand, rising cost, office vacancies. Rates in major cities like New York, San Francisco have reached record high. In some areas, vacancy is about 25%. Entire buildings are sitting half empty or worse. But the debt tied to them didn't disappear. It stayed. This is where it becomes systematic, because it's not just property owners involved. Banks, pension funds, and institutions are all connected to this debt. And when asset loses value while debt is high, pressure builds across the entire financial system. Morgan Stanley has even warned that prices in some part of the commercial property market could fall as much as 40%. That's not small correction. That's a structural shift. And here's the part most people miss. Many of these loans were created when money was cheap. Now they're resetting in a completely different environment. Higher rates, lower demands, less liquidity. And that gap, that's where the risk lives. And here's what makes it even more dangerous. Now, no one knows exactly where the breaking point is. And the reason you don't hear about it everywhere. It's simple. This kind of crisis doesn't explode overnight. It unfolds slowly, quietly, one loan at a time, one building at a time, across cities, across countries, across entire economies, until suddenly it's too big to ignore. And by that time, it becomes obvious to everyone smart money has already moved. That's when the biggest opportunities and risks are already decided in advance by those paying attention early and acting fast today, now ahead fast. Now here's where things start to get dangerous, because this isn't just about empty buildings. It's about what happens next when these loans come due and property owners can't refinance. They are forced into two options: sell the asset or default. But here's the problem. If many owners try to sell at the same time, prices drop even faster. And if they default, banks are left holding assets that are losing value. This is how a domino effect begins. One default turns into two, 2 to 3, and 3 to 10, and suddenly entire portfolios start collapsing. This is exactly what happened during the 2008 financial crisis. But back then it was residential housing. Today it's commercial real estate, and the scale is massive. According to data highlighted by Bloomberg and major financial institutions, a huge portion of this debt is concentrated in regional banks. That means smaller banks are heavily exposed, and when losses hit them first, confidence starts to shake. Now combine that with rising interest rates, tighter lending conditions, and global uncertainties. Banks become more cautious, they lend less, businesses struggle to access capital, and growth starts to slow down. This is how a localized problem turned into a broader economic slowdown. And here's the key difference from 2008. This time the stress is more spread out. It's not one sudden crash. It's pressure building across multiple areas at once. Real estate, banking, debt market, all interconnected. And because it's slower, it's harder for people to notice. There is a single moment where everything breaks. Instead, it's a gradual tightening, a slow squeeze until eventually something gives. And when it does, the impact spreads quickly. And here's something even more important. When banks take losses, they don't just stop lending to developers. They tighten across everything: businesses, consumers, entire industries. That's when economies feel it. That's when jobs, growth, and spending all slow down together. That's when it becomes real. And when confidence drops, markets react even faster. That's why smart investors don't wait for the headline. They watch signals early, because by the time panic becomes public, the biggest move have already happened. And the people who understood the domino effect early are already positioning on the other side of it, already prepared, already protected, already ahead of everyone else. Now, here's the part most people completely miss. While one side of the world is dealing with pressure, debt, and uncertainties, the other side is absorbing the money. Because in every crisis, capital doesn't disappear, it relocates, and it finds its home. Right now, one of the biggest winners is the UAE. According to Henley and Partners, the United Arab Emirates ranked number 1 globally for attracting high net worth individuals, with over 5,000 millionaires moving in a single year. Think about that for a second. Thousands of millionaires, each bringing capital, business, long-term demand. That alone represents billions of dollars entering one market. But it's not just individuals. Major developer firms are expanding their presence in Dubai. Companies like BlackRock, Goldman Sachs have been increasing their activity in the region, alongside hedge funds, private capital firms setting up offices. Why? Because when uncertainty rises globally, money looks for 3 things: stability, safety, and return. Dubai offers all. The currency is linked to the US dollar, which means stability in volatile times. There is zero income tax, which increases net return, and the city continues to see strong population growth, tourism, and international demand. That combination is rare, and markets that offer it tend to attract global capital quickly. This is why Dubai real estate has seen significant growth in recent cycles, with prices in some segments increasing over 30%. And even more importantly, projects are being sold out before they're even completed. That's demand, that's capital inflow, that's confidence. And here's what makes it even more powerful. This isn't short-form speculation. This is long-term positioning by global wealth. Institution money, private capital, family offices, all moving in the same direction. And the scale is massive. The scale is in billions every year, from Europe, from Asia, from emerging markets, from investors seeking safety and growth at the same time, from capital escaping uncertainty globally. While some countries are dealing with empty buildings and falling valuation, Dubai is experiencing the opposite. Rising demand, increasing transaction, new money entering the market every single day, same global conditions, completely different outcome, and this is where the biggest opportunities are created, not by following headlines, but by following the flow of money. And right now that flow is very clear. If you know exactly where to look and act early before others even realize it, fully in time, today, globally, now fast, moving capital flows everywhere. So now you see what's really happening. On one side of the world, there is pressure building, debt increasing, demand falling, assets losing value. And on the other side, there is growth, capital flow, demand rising, opportunities expanding, same global economy, two completely different realities. And the difference comes down to one thing: understanding where the money is moving before everyone else does. Because by the time it becomes obvious, it's already too late. To get the best opportunity, this is how wealth shifts happen. Quietly at first, then suddenly the people who win aren't the ones reacting to headlines. They're the one reading signals early, positioning early, moving early. So the real question isn't whether a shift is happening. It is already happening. The real question is, are you positioned on the right side of it? Or are you going to realize it after the biggest moves are already done? Because opportunities like this don't stay open forever. They reward speed. They reward awareness. They reward action. And the earlier you understand the shift, the bigger your advantages become over time today. If you want to stay ahead of where the money is going next, subscribe to the channel and like this video.